This is Nightly Business Report with Bill Griffith and Sue Herrera.
Bumpy week. Stocks turn lower after reaching for records as investors are reminded of the risks to the market.
Risky business. A Fed official makes an unusual call highlighting the rise of co-working spaces as a new source of financial instability.
Timeless treasures. Used watch sales are booming, and now elite brands want a piece of the pre-owned profits. Those stories and more tonight on Nightly Business Report for Friday, September 20th.
And we do bid you a good evening, everybody, and welcome tonight. It was an eventful Friday that capped off an eventful week, one that saw the Federal Reserve cut interest rates for a second time this year, and an attack on the center of Saudi oil production that boosted crude prices. But through it all, the stock market's major averages continued their climb toward all-time highs. And early on today, it looked like that might happen. But it didn't. A headline this afternoon related to the trade war between the U.S. and China reminded investors once again that risks still remain, and stocks reversed course and headed lower. The industrial average by the close was down 159 points to 26,935. NASDAQ was down 65 and the S&P was down 14. And with today's sell-off, the major averages snapped their three-week win streak. Bob Pisani reports tonight from the New York Stock Exchange.
Stocks failed to close higher for a fourth straight week, but the Dow and the S&P are still sitting just shy of new highs. The markets are clearly still fixated on trade developments. That was amply demonstrated today. The S&P lost nearly 20 points in the middle of the day on word that Chinese officials would be cutting their trip to the U.S. short without giving any real reason. So, predictably, we saw global farm-heavy industrials like Caterpillar and Deere sell off, along with other trade-related movers like semiconductors, over fears that U.S.-China trade talks may not be going as well as some were anticipating. Still, the market has proven remarkably resilient. The S&P is little changed this week despite a string of other potentially bad news besides trade. The Iran sanctions, the surge in oil, and very poor China industrial production and retail sales numbers. That was earlier in the week. But investors remain cautious about chasing new all-time highs ahead of pivotal trade negotiations. We saw that today. The Federal Reserve, remember, also seems to be moving to the sidelines on any rate action for the moment. Cyclical sectors that are sensitive to the global economy that had rallied in prior weeks, well, they're all back down this week, including industrials and metals and mining, retailers and regional banks. Next week, we'll get no shortage of potentially market-moving catalysts, including another look at second quarter GDP, international trade, personal income, consumer confidence, all coming. We'll also get plenty of commentary from Fed officials and a host of housing data, which has been much stronger than expected lately. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And joining us now to talk more about the market is Jack Ablin. He is the founding partner and CIO at Crescent Capital. Good to see you, Jack. Welcome.
Nice to see you too, Sue.
It's been an interesting week, to say the least. We made little progress on trade with the Chinese, especially with what happened today. But we did see a move to the downside in interest rates by the Fed. So how do you feel on this Friday about the market?
Well, I think the Fed is probably as confused as the rest of us. You've got this data-dependent Fed in a headline-driven market. I'm data dependent too, and I have a real difficult time getting my bearings on where this market is headed. So I certainly can sympathize with some of these Fed policymakers. They did reduce rates. The market really didn't react that much, and I think they've more or less expressed to the market for now that they're done for a while unless conditions change.
At least one Fed official said this week that as long as the consumer is still there, this economy will be fine. And you have to admit, that has been the strength of this economy lately, right?
Absolutely. We did have a little bit of scare earlier in the week with the 10% spike in oil prices. Remember, in recessions past, it was spike in energy prices that really drew away from household expenditures because people have to get to work and pay for gas. That quickly reversed on Tuesday, and it looks as though the consumer is still very healthy. In fact, if you look, one of the statistics that we track is how many miles can you drive on 1 hour's worth of work, and it's still over nearly 300. So it's a very strong number right now.
The market still would like to see lower interest rates from the Fed, but you make the point in your notes that you say low rates are self-defeating, she tried to say. What do you mean by that?
Sure. So what's going on, Sue, is we've now made borrowing so easy among corporate America that even companies that shouldn't be in business are in business. Take, for example, Sears. Sears has been struggling for more than a decade, and even with these lower interest rates allow a company like that to stay in business. Now, perhaps on the surface it seems like a good thing. They still operate nearly 400 stores. They've got 23,000 employees. But what they're doing is they're taking productive capacity away from profitable businesses, and they're also competing with profitable businesses and then holding prices down and productivity down. Two key ingredients that the Fed would like to see higher.
All right, Jack, thank you very much. Jack Ablin with Crescent Capital. Bill?
Well, we heard from a few Federal Reserve officials today after this week's split decision to cut short-term interest rates by 0.25%. Vice Chair Richard Clarida, who voted for that cut, said the consumer is in excellent shape, which will help the economy along, but he said risks do remain.
We clearly have a slowing global economy. The OECD just this week marked down its global outlook. Obviously, the U.S.-China relationship is important, but there's a broader global slowdown. There's a slowdown in global capital spending, in global manufacturing, and there are also some pretty important disinflationary forces.
Now, James Bullard, who's the president of the St. Louis Fed, said the manufacturing sector already appears to be in recession, which is part of the reason why he wanted a deeper 0.5% cut at this week's meeting.
But the call that really caught our attention is not one usually heard from a Fed official. This warning had to do with co-working spaces, companies like WeWork, and the risk that they pose to the economy. Steve Leisman explains.
Boston Fed President Eric Rosengren, explaining his decision to vote against the Fed's rate cut this week, said his big concern is keeping interest rates too low for too long could lead to financial instability and bubbles in asset prices created by those low rates. And Rosengren singled out a business model used by WeWork as a possible source of future losses and instability. The Boston Fed president said low rates can encourage excessive risk-taking, create too much leverage or debt in the system, and cause investors to reach for yield. One example, he said, the real estate model known as co-working space used by WeWork, which Rosengren did not specifically name.
Very aggressive monetary policy has probably birthed some of the issues that we now have at this point in the cycle with respect to firms like WeWork. I think the question we need to ask ourselves is WeWork just the tip of the iceberg? Does that call into question the valuation of all these other unicorns? And then does that then have a flow-on effect into the real economy in terms of investment, spending, and growth that then could lead to some kind of unraveling of this cycle?
Under the co-working space model, WeWork rents vast amounts of space from landlords and becomes a major lessor in important commercial real estate markets like New York and Los Angeles and even Boston. It then subleases that space to tenants. So what's Rosengren's problem with all this? He says the co-working model involves short-term leases to small, less mature companies that are going to be the first ones to go under in a recession. Landlords and banks are potentially at risk because they don't have a lot of recourse in their agreements back to the parent company of WeWork. Cities also with a lot of co-working firms in it can face more defaults because of the concentration. Rosengren doesn't believe the WeWork model will create a downturn. What he's saying is that it could make a downturn worse once it happens. For Nightly Business Report, I'm Steve Leisman.
In other news, the White House today imposed sanctions on Iran's central bank in retaliation for those attacks last weekend on Saudi Arabia's oil facilities. The Trump administration believes that Iran was responsible for those attacks. The Iranian government, though, has denied it. Treasury Secretary Steve Mnuchin said that the new sanctions were designed to cut off the last remaining source of funds for Iran.
As we reported, those weekend attacks knocked out half of the country's oil supply. Today, Hadley Gamble got a look at the fields where the repair work is now underway.
Nearly a week after the worst terror attack Saudi Aramco has ever seen, an assessment of the damage. Now, as you can see behind me, significant damage to one of 4 stabilizers. This is just one of 4 locations within Al Kharais that were under attack around 3:40 a.m. in the morning over the weekend. Aramco telling us that they were able to put these fires out within 3 to 4 hours of the attacks, but that didn't stop at least 1.2 million barrels per day from being knocked out of production.
Al Kharais is just one of 2 massive facilities now under repair, with the government hoping to get back to full production as soon as possible, and crews working around the clock to get the company back on track. Earlier this week, Saudi defense officials showed evidence of what they say was Iran's direct involvement.
So, according to Saudi defense officials, 18 UAVs were launched at Al Khaik. Now, behind me is one of 11 spheroids that were hit in the attack, and this is a plate from one of those spheroids, and you can just see how massive the damage that was done. So again, 18 UAVs were fired at this facility alone, and also 7 cruise missiles were fired, supposedly, according to Saudi Defense Forces, at both facilities.
Known as the mothership, Al Khaik is the largest oil and gas stabilizer in the world. And just days following the attack, this facility already back to 2 million barrels per day. And the oil minister says they'll return to full production by the end of the month. But the charred spheroids and stabilization columns, many with gaping holes punched through their steel casings, serve as a grim reminder of what using oil as a weapon can look like. For Nightly Business Report, I'm Hadley Gamble in Saudi Arabia.
And in the news tonight, the devastation caused by the remnants of former tropical storm Imelda. That storm has flooded parts of southeast Texas, dropping 40 inches of rain, making it one of the 10 wettest storms in U.S. history. It's already being compared to the devastation caused 2 years ago by Hurricane Harvey. Officials, though, are still trying to assess the full damage.
It is time to take a look at some of today's upgrades and downgrades. Etsy was upgraded to outperform from sector perform at RBC Capital Markets. The analyst cites recent initiatives that will have a positive impact on the company's performance. The price target is $68. The stock rose 2% to $60.41. Coverage of Roku was initiated with a sell rating at Pivotal Research. The analyst cites increasing competition in the streaming device business, which he says could drive the cost of such devices down to zero. The price target is $60. The shares fell 19% to finish at $108.05.
Still ahead, a high-tech prognosis.
I'm Bertha Coombs in Boston. Coming up tonight on Nightly Business Report, Humana's new digital hub feels an awful lot like a tech startup, and that's the point, as the Medicare giant makes a big push into digital health.
California and 22 other states are suing the Trump administration. The states are challenging the White House decision to revoke a rule that allows California to set tougher car emission standards, something we reported on earlier this week. California has been able to set its own rules since the 1970s because it has the most cars on the road of any state, and it struggles to meet air quality standards.
Health insurers are always looking for ways to make health care costs more effective. And Humana thinks that the answer may lie in Boston, which has become a hotbed for health tech startups. Here's Bertha Coombs.
Humana's new digital health hub in Boston has the look and feel of a tech startup.
It's personalizing it to the members so that we can use their historical information.
For CEO Bruce Broussard, that's very much the point.
We're trying to bring different disciplines together to wrap around the whole idea of this agile development. And the ability to have consumer design individuals, analytics capability, data scientists.
The company has hired 75 developers in the new unit over the last few months, and already the team has helped build out one of the insurer's first digital projects, a virtual primary care service with telemedicine provider Doctor on Demand that launches in January.
We give you these tools that you can utilize through the phone, through the iPad, where we're monitoring your health, and a signal is created. We can bring that back to your doctor.
It's a big investment for Humana, but the Medicare giant is hoping the new hub will help it better compete with rivals like CVS, which is betting on its retail health clinics to improve care, and upstarts like Haven, Amazon's health venture with JP Morgan and Berkshire Hathaway, also based in Boston, which aims to lower costs through technology. For the area's bustling health tech startup community, the Medicare giant presents a chance to develop services that can go national quickly.
Humana is doing some really cool things with their digital health and analytics group to be able to integrate those entrepreneurs much earlier in the process. So you're seeing a lot tighter collaboration, which should ultimately compress the time it takes to bring a startup's company to market and scale.
For Humana, speeding up the time it takes to develop technologies that can leverage better care and lower costs for its members is the key to holding on to them for the long haul in what is increasingly a very competitive Medicare Advantage market. For Nightly Business Report, I'm Bertha Coombs in Boston.
There's a driving force behind many of this year's big IPOs, and it's called Stripe. Stripe handles all of the technology that allows companies to accept online and mobile payments. And as Deirdre Bosa tells us, it has a wide reach and it's growing fast.
You can't see Stripe, and you probably haven't heard of it.
Of what?
The app Stripe?
No. App Stripe? No. What is that?
Stripe app? No.
No, I haven't.
The Stripe app? No.
But it is right here in your pocket and behind some of the biggest apps on your smartphone. The San Francisco startup processes hundreds of billions of dollars in payments annually for some of the biggest companies in the world. It was founded in 2010 by Irish brothers Patrick and John Collison, who moved to the U.S. for college. They went on to create Stripe, which quickly became the payments infrastructure behind a generation of rising tech powerhouses, from Lyft to Instacart to DoorDash. Less than a decade later, it also counts large established companies like Amazon, Google, and Target as customers. Stripe is now one of the highest valued private tech companies in the world, also known as unicorns, having just announced a round of financing from some of Silicon Valley's most prestigious venture capital firms. For the next phase of its life, Stripe may be taking on more risk. It'll use the fresh funds to expand into new international markets and into new businesses like lending, putting it in competition with other more established companies like Square and PayPal. For Nightly Business Report, I'm Deirdre Bosa in San Francisco.
McDonald's hikes its dividend, and that's where we begin tonight's market focus, with the fast food chain raising its dividend by 8% to $1.25 a share. Company CEO Steve Easterbrook said today that the hike reflects the company's continued focus on driving long-term value for all stakeholders. Shares, though, fell a fraction with the rest of the market to $209.39 today. Netflix shares took a hit today after a note from analysts at Evercore said that international growth could slow, which it has been doing since July. This comes as Netflix faces stiff competition this fall as the likes of Disney and Apple launch their own streaming services. Netflix shares fell 5.5% today to $270.75.
The FDA approved the expansion of 2 of Merck's HIV treatments for adults who are, quote, virally suppressed. The expanded label now gives certain HIV-1 patients the choice to switch their current therapies. Merck rose about 1.5% to 85.16. Walmart will stop selling e-cigarettes due to the growing global health concerns of vaping. The retail giant plans to continue to sell its current batch of e-cigarettes until the inventory runs out. The news did not impact Altria, which owns a 20% stake in Juul, as shares were up nearly 2%, while Walmart dropped just a fraction.
Time for our weekly market monitor. He has 3 picks for us this week that he says can thread the needle between risk awareness and steady growth. Joining us this week, Mike Bailey. He's Director of Research at FBB Capital Markets. Mike, thanks for joining us this week.
Great to be back.
You've got 2 defensive plays and then a growth play. First defensive play, very much a household name, Clorox. Why that one?
So Clorox, some of our picks this week are relative, compared to something. So for Clorox, one of the things we like the space. So if you want to be defensive, consumer staples, great place to be. What do you want to own? Do you want to own, the highest quality name, or maybe something, that's a little bit cheaper? So for us, Clorox actually has gotten a bit cheaper relative to some of the others. So for example, Procter & Gamble, a very nice company, has been around for a long time. That one's actually gotten pretty expensive. So we think in the space, you want to own a high quality company that at a discount. Clorox, interestingly, is a lot smaller. So they actually benefit from sort of the law of small numbers, which means they can grow nicely for a number of years. So I think as you think about Clorox versus a bigger competitor, you want to stick with something that's a little bit more attractive in terms of valuation.
Next on the list is Eli Lilly. It's a defensive play in your book, but it also offers growth at a reasonable valuation.
That's right. So again, on that theme of sort of relative, Eli Lilly, interestingly, is kind of turning the corner from a boring sort of slow growth drug company. They're actually starting to speed up. They've got some interesting diabetes drugs, some drugs for cancer. In some ways, the new Lilly is sort of like the old biotech. So in the good old days, 5-10 years ago, big biotech companies were growing 15-20% a year, and they had big, expensive valuations. Lilly actually is starting to turn into that. It's a big company. It's going to be growing very quickly. And we think the valuation is actually pretty reasonable. In fact, you're sort of paying the same price as you would for the whole stock market. For a company like Lilly, it's got a nice dividend. It's growing much faster. We think that's pretty compelling.
Now, your growth play is Salesforce.com, of course, the pioneer in customer relationship management. But as a growth play, does that mean if the economy slows down, so does this company?
Well, it could. It certainly could. If it's a high growth company now, if you're seeing layoffs and things across the board, certainly this company's going to feel a little bit of heat. Again, going back to that theme of thinking from a relative basis, if you already own some defensive, maybe slower growth names, you want to kind of jazz it up and add a little bit of growth to it. So this is a higher growth company. You're right. If we hit a recession in the near term, a big growth company like Salesforce, they'll slow down a bit. However, we think some of that maybe skepticism may be a little bit overblown. So they sell a lot of software into governments, into nonprofits, into areas that we think even in a recession you're going to still see some spending. So additionally, if you're looking to save costs, if you're a big bank or something, if you cut off your Salesforce business, that's what actually drives new customers. So it seems like that's something you probably want to stick around with even during a recession.
In the 30 seconds we have left, Mike, do you feel as though we're headed for a recession, or do you think the economy is really doing pretty well?
I think we're in pretty good shape. For what it's worth, as an anecdote, I just passed the Apple store on the way here. There's a line out the door. There's new Apple phones coming through. So if you think about the consumer, they're in pretty good shape. There's some other risk factors out there. I think you really have to balance that out. I think we're in pretty good shape for a few more quarters until you start to see a slowdown.
Mike Bailey with FBB Capital Partners. Good to see you again, Mike. Thanks for joining us.
Great. Thank you.
Coming up, the big profits being made in pre-owned luxury goods. Here's a look at what to watch for next week. On Tuesday, Dow component Nike reports earnings. We'll find out if tariffs are impacting its business. There's been a lot of focus on the housing market, and on Wednesday, new home sales for August will be released. And also on Wednesday, a House panel holds a hearing on the recent surge in vaping-related illnesses. And that's what to watch for next week.
Finally tonight, though, the market for used luxury cars, usually referred to as certified pre-owned, that's become a very big business. And now there's a big market for other pre-owned luxury goods like high-end watches. Robert Frank has our story.
The luxury watch industry is under pressure from slowing growth and trouble in Hong Kong, the world's largest Swiss watch market. But one segment is booming: online sales of pre-owned or used watches. Analysts say pre-owned sales are now growing twice as fast as new watch sales and will soon top the $20 billion a year in Swiss watch exports. So watchmakers, well, they're fighting back. Audemars Piguet, one of the most elite and profitable brands, is launching a new program to buy and sell pre-owned watches in their retail stores. They will buy a watch back from a client who may be trading up. They'll refurbish and repair it and then offer it for resale with a warranty. It's a bit like certified pre-owned cars, because like cars, new jewelry and certain watches can fall 20% or more in value once they leave the store. Now, Audemars is starting small given the cost and time of restoring watches. But the company says the move is less about added profits and more about better serving clients, cracking down on counterfeits, and managing resale prices for watches that can cost six figures.
Brands only took care of their first child and never the second one. So basically we, the whole watch companies, left the secondary, the pre-owned business to outsiders. And I think it's about time that we are bringing this back home.
Watchmaker MB&F is now offering its pre-owned $70,000 watches on its site. And Richemont, which owns Cartier, Panerai, and IWC, acquired online seller Watchfinder for over $100 million, giving Richemont a platform to sell its own pre-owned brands. Rolex, which drives much of the pre-owned market, declined to comment on its plans, but others are likely to follow, as younger buyers are changing the pace of watch buying.
20 years ago, you could have bought a watch for your life. That was one watch, that was your life. Today, people trade sometimes over 3 months, 6 months.
For Nightly Business Report, I'm Robert Frank.
And before we go, here's another look at the final day's numbers from Wall Street. The Dow fell 159 points, the Nasdaq was down 65, and the S&P 500 slid 14. With today's sell-off, the major averages snapped their 3-week win streak. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you Monday.